techy in a way. So for today, we'll be talking about something that is very, very important, money, of course, for all startups. That's one thing that we all want, to make sure that we have enough money to just survive or even scale from one place to the next. Yeah, so Wangeshi will talk deeply into private equity, which is one source of funding for companies, but I want to just delve a little bit into the African ecosystem, the tech ecosystem in Africa. So as we start off, we have different investment cycles for startups. Yeah. So basically, when you're starting out, you at ideation stage. That's when you have an idea, but you've not worked on it. And at that particular moment, you can actually still get funding. And in most cases, at this stage, you get funding from friends, families, and what we call fools. So that's ideation stage, and then we have seed stage. That's the point whereby you start getting funding from either angel investors or private equity funds. Then early stage, mid stage, late stage, exit stage, that's where now the people who funded you exit, and then post-exit stage. So I'll talk a little bit about types of investments. Yeah, so in all those stages that I talked about, there are ways of you getting money. Yeah, so when you start with pre-seed stage, of course, you can start off with your personal savings and get money either from your friends or family if they believe in your idea. And then, of course, seed stage, that's when probably you've built a prototype, you have an MVP, you have something that you can actually show people. So you start getting funding from angel investors, accelerators, and incubators. Yeah, and what we have currently, especially in our region, Nairobi, Kenya to be precise, we have a lot of angel investors around. We have a lot of accelerators just giving out money to early stage startups. So whenever you have an idea, whenever you have something that you built, always try as much as possible to see if you can get funding from all these players in the ecosystem. And then we have early stage. Of course, within early stage, there are different series A, B, C. Depending on where you are, you can actually get as much money as you can, again, depending on where you are. And then mid-stage, late stage is when probably you now, if you're a private company and you want to go public, then you go to the IPO stage, which is initial public offering, whereby you exchange your shares with money from the public. And then, of course, at exit stage means probably we can have IPOs and mergers and acquisition, basically. And that's where also most of the angel investors or even accelerators or incubators that would have funded you at the seed stage and early stage exit. And then we have post-exit. In Africa, the private equity landscape is actually growing, and it's growing and evolving at a very fast stage. Yeah, so what I know is that at least in West Africa, East Africa, partly North Africa, that's Egypt and Morocco and South Africa, there are a lot of funds coming up that are actually giving money to our startups. And in Kenya, last year alone, I think there's one startup that I usually like to talk about called Market Force. I think they raised almost 40 million USD. And he was someone who actually started his idea in campus. We were in campus together. I don't know what I'm doing right now. Yeah, but he started his idea in campus, and he sold his first company, which is called Cloud9. Right now, he raised, in total, he has raised 40 million USD. So he's someone, he's around, he's 29 years old, I think, as of this year. So these are things that you can actually do. So again, like I said, don't ever be afraid to look for money wherever you can, as long as you believe in your idea and it's an idea that people can go and back, you can always get money. In terms of sectors, we have AI. I think Wangeshi talked about it yesterday. Internet of Things, agri-tech, fintech, prop tech. And these are not the only sectors that invested in. There are a lot more sectors. So, but these are the key investment sectors, especially in our region. And then, of course, there's an increased interest from both local and international investors, especially in the regions that I've mentioned. Yeah, so the fact that you are already in Kenya, that gives you an edge over other countries, over other ecosystems. Yeah, because apparently we are smart and we come up with things that revolutionize the world. For example, M-Pesa. In terms of the regulatory environment, of course, there are different frameworks governing private investments, private equity investments. And Wangeshi will also talk more about that. But we all know about CMA, the Capital Markets Authority, NSC, and CA. They're in charge of regulating that particular market. And then now, the role of PE in the startup growth, of course. Sometimes in startups, if you don't have money, you might have the best idea ever, but if you don't have money to execute, then it means that you won't move from one stage to another. You won't get to acquire your customers as quickly as possible. You won't be able to iterate as quickly as possible. You won't be able to research and get the right product to the market. So all these things need money. Operation, because of course you'll have costs, operational costs. You'll have to pay people to probably build your prototype. You'll have to pay people to market your idea. You'll have to pay a lawyer to register your company. So all these things need money, yeah? And all these things, for you to be successful in a way, you have to get money from somewhere. And one of the ways of getting money is through PE. Yeah, so the role of PE is very, very critical for startup growth, because it basically catalyzes the growth, to make the growth as quickly as possible, so that you can beat your competitors, so that you can acquire as much market size as possible. So in our context, basically, there is rapid growth and diversity in the various sectors that I've talked about. And in terms of innovation hubs, we have Nairobi, which is very, very vibrant. We have Cape Town and Lagos. All these cities, actually the cities that lead in Africa when it comes to tech. Most novel ideas come from these cities, but doesn't mean that a novel idea cannot come from this county, yeah? But these are the most innovative cities in Africa as is today. Yeah, and then of course there's an increasing trend of local and international investments. So, of course, we'll talk about innovations and financing. We are talking about innovations and financing innovation. So, the role of innovations and technology, of course, with the direct adaptation of latest technologies that are solving problems, means that as long as you're solving a problem that is dear to the community, then it means that you're able to, sorry about that, you're able to get funding, yeah? And then we have mobile technology, which is also a catalyst for innovation, and of course collaboration and partnerships, which is also helps in fostering innovation. And I think I should be done. Wangeshi will go deeper into funding sources, PE, what PE is from a legal point of view, and also an in-depth point of view. Thank you so much for, yeah.
All right, I hope you've learned something so far. Is it too much? Are we learning? I hope we are. So, yeah, I think James started by talking about the life cycle and the different stages. And this whole day has been all about financing. I am sorry I missed out the first two sessions, but I'm hoping that some of these sources were captured. So most people will tell you that when an investor is coming to invest in your idea, they want to see how much you've put in it. So most of the time what you do is you don't start an idea and you don't build it alone. Obviously you have the concept, but it helps when you have a team. So your initial team form the co-founding team. And what they do is they get something called sweat equity. Sweat equity means I'm not bringing money to it because in any case, I don't have any money to put into it. So what I'm bringing is an idea. So supposing here I am, I need a techie. So their role is to develop, and I need somebody maybe who can figure out finances, and I'm not good at that. You end up forming a team of people who can be able to build something, and what you all get is sweat equity. In the startup world, unlike in the normal SME world, you invest in your equity, and how you invest in your equity is you do something we call vesting. So the biggest issues that I face when I see startup structures being done wrong is you find a startup has gone and registered a company and fully given shares. And then 2 years you've left school, or you're no longer friends, or you had a business venture with your parents and it's no longer working. So what happens? Do you dismantle the company? So a country called Delaware initiated this by doing something called vesting. And vesting means I have to earn my shares over a period of 4 years. So if I am entitled to 20%, so year one, I only get 5%. I mean, and not year one when I start. If I finish the year 2023, having been in the company, that's when I get my 5%. Then 2024, another 5%, 2025, 5%, and finally in 2026, 5%. So what that does is it makes sure that your founders remain and help you build. Why? Because we're testing out hypotheses, we're not sure. The second other initial people to join your team, of course, besides your friends, families, and fools. And the reason we say fools is who is fool enough to come and invest in something we don't know whether you can be able to sell or not. So they come in as angel investors, and here they give you small money. Sometimes even 100,000 shillings is good money, and they've invested in something. It's something that they have to be willing to lose. We have syndicates, as James mentioned. One of the biggest syndicates we have is NIBAN, Nairobi Angel Investment. It's actually run by a very good friend of mine called Nick, who used to run a venture building at the Silicon Valley. Then the next thing is and of course at this point in time you can either choose to bootstrap. Bootstrap means I'm not going to look for venture fund, and you don't have to. The best performing bootstrapped company we have at the moment is a company called Zoho. Who knows about Zoho? Guys in tech. Zoho for startups. Oh, I can see a few people. So you need to check them out. So Zoho started in India. They're currently valued over $2 billion. They were bootstrapped. They never asked for a single coin. Companies like Microsoft, Apple, and the likes actually asked for investment. Zoho did not. So now that you can also, of course, get through loans. I don't want to mention too much about the loans you get from banks, but there's a special category of loans that you get from venture builders. It's called convertible debt or convertible loan. It means if an investor comes and gives me 100,000 Kenya shillings, I can either choose, or they can choose after 2-3 years to either convert it into shares or I pay them back. So that's what we call convertible debt. And then, of course, grants is money that you don't give back. A lot of the time, that happens with social impact initiatives. Someone yesterday asked, what happens when I'm trying to build something and we have Vision 2030 and I'm trying to get into certain agendas? There is a huge interest right now with a lot of VCs that are looking for impact investing. In fact, in my phone, my phone cover behind here is a brand called Mila Center. They are constantly looking for startups to invest in that have an impact-centered mind. And one of them is gender lens investing. They want to see, do you have female founders in your team? And of course, venture funding is a lot that I'll talk about, and that's any VC or PE firm coming to put. Now, something new to our environmental and our regulatory framework is crowdfunding. 2022, we got the regulations of crowdfunding. So this means that I, as a startup, I can have my startup listed somewhere, and I can ask for the public to come in and invest. And most of the time, you're talking about VC angels, but even a simple investment of 1,000 shillings works. We have a company right now called Raise. They get Raise. They are Kenyan founded, but they've been building some good rapport in Nigeria because Nigeria had the regulations early, and they're coming back to Kenya. And you can invest in a startup from as low as, I think, 1,000 shillings. So that's one of your ways. But the rule right now with the Kenyan crowdfunding solution that we have is you have to have your corporate structure in place, meaning you need to have a proper functioning board. So that's something that startups fear, and you're wondering, how do I put up structures? Without structures, you're not going to get investing, but most importantly, without structures, you may not also grow. So what exactly is private venture? Ideally, it's private equity is investing in privately held companies. So you've all seen people buy equity in companies like Safaricom, yeah? Equity, KCB, a lot of these organizations, you can come in and buy said equity. Normally what happens is at that point in time, they attained an IPO. I don't know how many are young enough, let me use the word young enough to remember when Safaricom IPO came in. At that time, our parents were buying it for 5 shillings. I think in a month or two, it went down to 2 shillings plus, and then it started shooting up. So at that point in time, what that meant is that company has exited. They have gotten into IPO, so people can now publicly buy. So so me as a private equity person can no longer buy into that. However, there's of course the process towards privatization. So any company that is held privately, and it needs to be a company. It cannot be an LLP. It cannot be a business name. It needs to be a company which has shares. Then any person then can come in and buy. The rule here is anyone buying into it, they either want a controlling stake, or that's in the case of majority stake, or if they are getting minority, then they want to have some veto powers. They need to be able to have some controlling within the board. And what you find is, as in fact the characteristics, as I mentioned, is ability to acquire. So they want something significant. Then the other thing is private, so when it comes to private investment, you're looking for long-term investment. So if someone is coming to you and telling you, I want to come and invest for in 2 years, then that's not someone serious about private investment. So investments for private equity goes between 5 to 7 years return. So even as an angel investor, so if you have an angel investor that's looking to leave within a year or two, then that's a red flag, because they'll give you pressure, money that you can't make, and you need time to come back and test the hypothesis. If it's not working out, then you test, you pivot. So the kind of objectives we are looking at, of course, is you need to be able to aid growth. The money is supposed to also help you improve operations and prepare for strategic exits. I'll mention about exits later and what exit means. So the kind of investors here can, of course, again, be individuals. A person, high net worth individual can come in and say, I have 100 million to come in and buy. I'm pretty sure a couple of you guys are football fans. So some of you people have been following in the acquisition of Manchester United by Ineos in Saudi Arabia. Anyone? We are all going to pretend we don't watch sports. Or if we watch sports, we don't care about behind the scenes. It's good to know, even if you're watching football, learn behind the scenes. What's the business mindset? There's a lot of money in some of these teams that we're paying a lot of money to watch, yeah? So you have 2 wealthy people trying to buy Manchester United. So what that means is, as long as I have the billions or millions of money to come in and buy into the company that I'm trying to get into, then I can go ahead and do it. You have institutions. Institutions could be anyone. Case in point, anyone remember U-Mobile? There used to be a mobile telecommunications company called U. So that company was acquired by 2 companies. And one of them was Safaricom, the other one was Equity. It was split in the middle. So again, that's still part of private equity. And then, of course, you have PE firms. There are private equity firms labeled as private equity firms. And I'll just mention, in Kenya, we have some that are doing very well. Globally, we have one that stands out that's called Blackstone. It's been there for more than 30, close to 40 years now. And it's invested in some of the biggest companies like Google, Microsoft, and all that. So all these people do is look for companies that look like they're going to make it, with the expectations that one company is going to make me so much money. So they don't bet on the 90. As we mentioned yesterday, you have a 90-10 rule. They don't bet on the 90 that will fail. It's the 10 that makes it. Most of the time, you get an internal return on investment 20, 30 times more. So if I invested in $1 million and I'm getting a return times 30, how much am I getting back? And I can exit, meaning I can sell out my shares, and I'll show you companies that have done so in a bit. Time horizon, as I mentioned, it's 5 to 7 years. And you're looking for value creation in terms of, are there changes? Are you coming in to make some changes? As I mentioned, improvements and the likes. The exit strategies that we're talking about is, one of the exit strategies is IPO. You've gotten to a point where the company can now become a publicly listed company. There's one company that's actually on the process of doing so, and it's one of the case studies that we'll be mentioning. The company is called Cellulant. It's been in the space from 2004. It's raised through all the different series. They started with bootstrapping for 4 years, then they went to Series A, Series B, Series C. Then they got additional acquisition. And finally, since 2021, they've been preparing themselves for an IPO. So of course, by the time they get there, hopefully you'll be on the lookout and see whether you are willing to invest at that point in time. Then another thing, when you're looking for either of the investors, either from the investor side or from the startup side, is aligned interest. The worst thing that can never happen is you get an investor who does not understand your sector or your vertical. If an investor, I'll give a good example. Hyper invest in agriculture, because that's what they do. So if you're doing something on fridges and whatnot, and it has nothing to do with them, then they expect different returns. Their value and the expectations of you are completely different from what you do. You have investors that purely focus on fintech and e-commerce. When you're dealing with fintech and e-commerce, then you're talking about scalability, speed, and all that. So if such an investor is not too familiar with what happens in agri-tech, then what they do is they come with unexpected realities and things change. Another thing you find is you get an investor who comes in and completely changes the concept of your startup. And this has happened so many times. You find the company has completely changed the focus, or even the company has gone down because change of people, change of management means change of, even the change of interest in customers. Case in point, when the startup ecosystem became vibrant in Kenya, the huge space, or the space that people used to work in at that point in time, was iHub. And everybody, I think a lot of VCs and a lot of investors who came into Kenya actually wanted to acquire iHub. Eventually, iHub was sold to a different entity that's the owner was from Silicon Valley. And changed the model. Quickly, iHub lost its interest. So companies like Nairobi Garage and all that came up, and people moved from iHub. So right now, it was then recently acquired by CC Hub. It's a company operated from Nigeria, and now there's a beginning interest because if it's an African-centered community, and it needs an African mindset to run something like that. And one more thing is on risk and reward. Private equities are about risk, high rewards. So anyone who's trying to put in small money and expect short time, clearly a red flag for that. So why get into private equity? And why ask for private equity when it comes to innovations? You want some substantial capital to grow. It is never, and this is where a lot of startups make the mistake. People get capital for the wrong reasons. The chances there is always to grow, not to hire a new dev or to just hire to do so much marketing and all that. Last year, I think the catalyst in the Kenyan ecosystem for startups that failed, we started a company called Kune Foods. And of course, Kune Foods came with the concept of, chakula yenu ni mbaya, you guys are eating kibanda food, we have a better way of packaging your food and bringing it to your offices. Probably with a better language, it could have worked. But eventually, anyway, they started with, of course, the cancel culture in Nairobi, but the biggest red flag was they did get eventually some investment. And the moment they got investment, anywhere you drive around Nairobi, you saw billboards. They opened up kitchen left, right, and center. You suddenly saw billboards at places that was so expensive to run a billboard. So internally, people would tell us that at the end of the day, they spend so much money on marketing, they never had time and money to actually focus on things that they ought to. So meaning they got their capital for the wrong things. Then, of course, you're looking at long-term perspective. So you want someone who is able to help you fulfill something 4 or 5 years vision. So you're not looking for, so with bootstrap money, most of the time you're looking for that money back quickly because you're in survival mode. But since you have private equity money, it means you can relax now. You can now start thinking, for the future. You can imagine if you have 500 shillings, and that 500 shillings is between you, rent, food, and everything for the entire week, versus you have 1,000 shillings, and all you need to spend is 500 shillings. So if you have 500 shillings to think about, can I invest? Can I do something else? Can I flex? Can I take a course? Something like that, yeah? So that allows you to start thinking bigger and stop thinking about your problems and actually start looking for solutions. Then you're able to get to high expertise and resources. You're able to cover yourself from risk. You can have flexible financing. But the flexible financing doesn't mean that you don't need to only get one type of venture investment. You can actually get venture, you can get debt, you can get different. But you can decide, how am I getting it? I can get a convertible note for 3 years, but I can also get venture capital fund for this duration of time. Then you, of course, are looking for supporting growth, as I mentioned. By support for growth is sometimes the investors understand the ecosystem and they make very good advices. So for those who've watched Shark Tank, you find during the pitches, you find a shark saying that I'm familiar in this industry. I've worked in it for a while. So I am the best person, not just to give you the money, but to give you the kind of expertise and sometimes even open doors for your company. So sometimes those are some of the things that you look behind when you're looking for an investor. Strategic guidance is something else, and of course, exit strategy. Is the investment easy enough to allow you get some of these things? Now, what are the challenges? And this is funny enough, that one of the reasons why startups feel like I don't want investment. The first one is you don't want to lose control of your company, yeah? So when you get investors, if an investor is putting $100,000, that's pre-seed most of the time. I mean, pre-seed or angel, most tickets start with $100,000. So when I'm getting $100,000, so what do you expect from the investor? They want decision-making rights, yeah? They want to decide which other investor comes in. They want to make certain decisions. You, as a founder, feel like, no, I need to have full control over what's happening. So most of the time at pre-seed, I mean, you're allowed to carry some bit of control. But as the company progresses, that control is lost. So if you're able to maintain your control without asking for funds, why not? That's good. But 90% of the time, startups are not able to, right? So you sometimes have to be willing to lose that level of control. The rule of thumb is if you're getting investment is during your pre-seed stage, you and your co-founders should still hold the majority stake. I guarantee you by the time you're at Series C, you won't. You'll be lucky to have 10 to 15%, which is okay because at that time your company is probably valued at $100, $200 million. Again, different type of control, different types of energy, so that still works. There's exit pressures. So sometimes you get investors that are focused on profit more than anything else. And we've seen a lot of startups struggling. I'll give a case in point. A company like Twiga came in and did so well. And there was so much pressure in. This is a company run by a very solid person. I think he used to be the general manager for Coca-Cola East and Central Africa a while back. And he understands the ecosystem, and he's come up with a good idea, and he's pushing it. So the obvious thing is you believe this person is going to make you so much money. So you start pushing for this. And I'm not saying Twiga Foods is failing, but I'm just saying sometimes you can feel that pressure. We have a very good friend of ours who runs a company called Nala. Nala is become one of the best performing fintechs. They're currently based in Nairobi and UK. And so a while back, in fact, we had invited them for the fireside chat, and they actually came out to say we had to turn down 10 million Kenyan shillings when it started, because was it million shillings or $1 million? I think $1 million, around that, and 10, yeah. And they had to turn it down because the pressures and expectations of the investor was, we want this, want an exit in this duration of time, want you to consider these markets. Sometimes you're not ready. Sometimes you've not tested the prototype. Most of the times, when you ask, why do African startups fail? And I've seen a lot of those discussions in the last 2-3 weeks about, and I don't know whether you also those newspaper articles talking about 6 startups that are failing in Kenya and in Africa, and what does that mean for the African context? One thing I'll say is give them a break. There's a lot of pressure from investors that we want you to exit, we want to make our money back. And 2, startups may fail, and startups may not fail, startups will pivot. We had Copia here. Copia had so much pressure to move around and scale and try to make profit. At some point, they had to come back and say no. Yeah. We all remember Nakumat. The case of Nakumat and why Nakumat failed. Again, not a startup, it's an SME, but same route. We call it hubris. Hubris means, I can strive for more, I can move to all these spaces, I can open any place at any mall and all that without care and considerations because, well, we have it right, we're on the right trajectory, everybody is telling us that we're doing so well. So you believe it, it gets into your head and you move around it. So sometimes when you have that in your head and then you have the pressure from investors, bad catalyst, then you see startups failing. It's not necessarily bad for the ecosystem, it's just a reality, because in reality, if you're actually supposed to look at Microsoft, things microscopically, Silicon Valley, there's a startup company failing every single day, and it is expected that they will fail, and if anything, a PE sometimes will tell you, just fail as fast as you can. If you're failing, fail fast so that we move on. It's still fine. But in Africa, our expectations are a bit different. So again, we talked about high expectations, meaning you expect them to make revenue, unrealistic revenue in so much time. You talk about investment costs. Sometimes there's a lot of costs that are incurred in setting up structures, in setting up operations, in setting up spaces. And of course, sometimes some of the challenges is alignment. So how do I align my interest with your interest if we are not aligning? How do we discuss about money, about hiring, about changes here and there? There's a startup friend of mine who's telling us that one of the time they actually got into partnership with an investor, and before they knew it, half the management team was run by white people, and they couldn't understand how the ecosystem works around Nairobi, and as a result, again, same struggle, same issues, startup failing. There was a time a startup in Kenya and in Africa could not raise without a white face. That's not the case right now. At least the landscape is changing. But those are some of the interests. If your interest is you're looking for white people or you're looking for certain people, if it's not working, it's not working, and it's okay to say no. Then, of course, information disclosure. And most of the time, this happens from the innovator side. We tend to lie a lot. You find an innovator coming in and telling you this prototype of mine will solve the world cure, will solve everything. There's a Netflix docuseries that had a startup founder, I've forgotten her name, Anna Elizabeth. She had this concept that she was saying that she could take a drop of your blood and she could test for more than 100 ailments. And she went into these boardrooms wearing black pull necks and with nice, strong pitch voice. And she raised so much money from people. And they actually believed. And before they knew it, a year later, nothing. There was nothing like that. It couldn't work. She had been cooking data. It couldn't work. Recently, I think in India, a month or two ago, we had a similar situation where a startup founder had been selling wrong data, sending wrong data to the investors, and they actually had gotten a lot of funding, only to come back and realize that at the ground, things are different. And of course, now that's why investors will always insist on due diligence. So management changes are some other challenges, meaning you bring in different people who may or may not understand the ecosystem, and sometimes you have a team that may not gel in. Exit strategy uncertainty. Sometimes it's not clear what path you're taking. Are you going IPO? Are you going buyout? Do somebody wants to exit? Are you all walking the same route? Market risks happen all the time. Anyone who was dealing with physical spaces and all that pre-COVID, and they had investment, of course they struggled. And that's, in fact, the year 2020 and 2021, we saw a rise in fintech and e-commerce. Why? Because then you understand, oh, this is a new thing, because this works regardless. But you could imagine if you had invested in something that requires something tangible, then of course you struggled. And it's a reality. Operational changes also happen. We talk about change management in organizations, but in startups, it's even much more critical because you change so fast and it matters. So what makes you attractable, or how do you prepare yourself for being investor ready, or for being able to attract a private equity investment? One of them is an investor will always ask for a pitch deck or a business plan, depending on which case. So as a rule of thumb, for the startups, we say that you need to have 3 different pitches. You need to have an elevator pitch, something you can talk about in less than a minute. And it could be, you can even create a slide that's 3 to 5, or even maximum 7 slides that you can just share. Just like an expression of interest. Lure the person in to understand, like to be interested in discussing more. An elevator pitch means, and it's something we say, prepare. If I meet an investor today, what do they ask? Sometimes we talk with investors and they say, we've gone in and met with innovators and we ask them, what do you want? And they even ask, okay, we like the idea, so what are you looking for? They're like, they don't know. They don't even know the kind of investment they're looking for. If I have an idea and I'm saying, hey, I am building a legal tech solution, this is what the problem is and we're trying to solve, and at the end of the day you say, we're looking for investment fund of $100,000 for a 10% equity. Then an investor actually listens because they understand, oh, I think we get you. But if you're like, yeah, we're building this, you spend so much time talking about your solution. Eventually they ask, so what do you want? They have 1,000 other people asking them that. So if you do not have an elevator pitch, then you're failing. Second thing is, if you do not have a proper pitch deck, they will ask for a follow-up pitch if they like you. So you need to always have a proper pitch deck prepared. And you can also later on also have something with accompanying documents, including a data room that I'll quickly mention later on. And the same happens with a business plan. Business plans mainly work for SMEs. With startups, the reason why we don't spend time on business plans is they will change. You're doing a 40-page business plan for an SME. If it's obvious, it's obvious. But for startups, you're testing hypotheses. And today something works, tomorrow it's not working. You have to validate. So it needs to be something that you can keep live. So the other thing is build strong relationships. People sometimes take advantage of LinkedIn, and it works best for them. If that is where you can go and build relationships, imagine do it. I think, like in the space that you're in, you may not have enough networking opportunities that people in Nairobi get. If you actually head to Nairobi every so often, try and find out the networking spaces, but take advantage of LinkedIn. I never realized the value of LinkedIn until I got into the to the ecosystem, especially even from legal. Like I, at some point, got a client who came looking for me from LinkedIn. But it's even much more better in the startup journey because there's so many investors from even outside the world looking to come in and invest in a Kenyan idea, and they don't know where to find them. So if they can see you and if you can see them, why not? But then you talk and talk and talk. You may not conclude something day one, but let people know what you're building. There's something we call a strong word of mouth. Meaning, if I meet somebody who is interested in business development and is so good and they're very keen, then I know, oh, by the way, James can actually do this for you because I know what they're doing. If I'm here and I'm thinking, startup grind, I'll be, oh, George, there's a startup grind in Kabarak. Would you come in and do something like that? That strong word of mouth exists if you continue having conversations with people about what you're doing and you understand and you explain the kind of things that you do, but you also need to return the favor. Prepare for due diligence. You will never get investment fully if you don't pass a due diligence. They will come in and scrutinize, do you have a company set up? You said you have, and by the way, due diligence is based purely on the things that you said most of the time. You came in and said, we've been making revenue, we've been making 5 million sales. The question is, have you? They have to come back and check, right? Then you talk about transparency is very key. Be honest about what you're building. But being honest doesn't mean go disclose everything you're doing. Embrace transparency with caution. Plan your exit strategy, have conversations about how that is going to go in, understand the ecosystem. I am glad that you guys are getting into this. Then there's obviously something we don't take advantage of, and that's strategic partnerships. It's important to know somebody who's doing something similar or linear to what you're doing, and you could share. Maintain communication, even with the kind of people who are investing in you, and be able to have some, like a good strategy, have a comprehensive approach, meaning I have strong planning, I have a good deck, I have strategy prepared, and I'm able to build relationships. So all these things, the pitfalls that we're talking about, if you're able to handle it, if you're able to understand yourself, then you're on your way to being well invested. So the type of private equity situations we're talking about is, one is a VC, as I mentioned, early stage funding mainly, and they offer and do mentorship. Then we have growth equity. Now you've gone past pre-seed. You're probably at Series A, B, C. So that's when you're getting the growth equity. Still you get VCs coming into this, and most of the time it's investment in established companies for expansion. Expansion means you're expanding to other territories. You're expanding to Rwanda, you're expanding to Ghana. And by the way, expansion doesn't have to be just Africa. We're big on Africa free trade agreements, but also outside Africa. Buyouts. That's the acquisition we're talking about. A company coming in and saying, I'm buying you out, like in the case of Q, and we've had so many companies go through it. I think Bitcoin at some point got bought out. So mezzanine financing is both debt and equity, so it's a combination. For those in real estate or prop tech, then we talk about private equity real estate. It's a different shade that purely focuses on real estate, again, because of the regulations and the modalities. And most of the time you find it's commercial real estate, residential infrastructure. We're now talking about segmented or structured real estate, where you find, I think I've seen 2 companies in the last 1 year from Kenya, and actually one of them recently got investment from Texas, where what they do is they have fractional ownership of an apartment. So we talk about fractional ownership in that I buy a house, an apartment in an apartment block. But here is this one single apartment, 20 of us can own it. Yeah? And so we split. If the apartment was worth 6 million, so we spread it across. Then we talk about distressed debt, where now I'm struggling. We need to either invest in assets or in the company. So sometimes a company is going to collapse. It doesn't mean that their assets will go down. So you can find somebody coming in and taking. In actual sense, partly what happened with U-Mobile, that was a case because we had 2 companies that were buying them out from 2 different angles. We had Safaricom that was buying their assets. We had Airtel that was buying their subscribers. But at that point in time, they were struggling. They were making losses. They needed an exit, and that was the best exit. Of course, then you talk about infrastructure, private equity. Again, that's on projects like airplanes, airports, utilities, hospitals, and the likes. So secondary markets is where you're buying and selling existing private equity stakes, meaning I buy an equity, I sell it, I buy another. There are people who do that, like hold on to things. Someone who is well known for that is Warren Buffett. That's all he does in a day. He will wake up, he looks at which one is good. He'll buy shares and even when they're still young, yeah? He'll buy shares at Airbnb and he's wait, you're picking up, sells it, moves on to the next. Impact investing, this is what I mentioned. It's so key right now, especially in Africa. You're having so many investors. So there's a program, there's an event called SunCup that happens every year. And what they do is they bring impact investors in Africa. And in Nairobi specifically, it's bigger in Nairobi. And what they do is these investors are looking for, they asking in your pitch deck, what is the impact that you intend to do? Fine, I am doing farming. Now that you're taking this money to go farm, so how is it changing the minds of the people around that? You can say we are employing 20 women who ideally would not be getting this, or we are supporting youth, unemployed youth, or we are doing this and that. So it's always tied to SDG goals, it's always tied to human rights and the likes, and this is big. Someone may not be interested in the profits that they're getting, it's a different way of doing CSR without actually doing CSR. Then we have specialized funds. These are specific, and you'll see in a bit, and of course I'd mentioned the hybrid version of it. So now I'm trying to not take so much of your time. So then we talk about the funding process. So how do you go through funding? The initial point is anyone can initiate. Sometimes you find an investor asking for a call, but most of the time it should be you going and identifying, so who would be an ideal person to come and invest in me? You can check out existing places that look out for them. There's so many events happening, and unfortunately, maybe they may not happen in this region, but in Nairobi, you find so many of them happening. You have companies like Sisters, Y Combinator, Texas. Please take note of them because they're big. You can go search on them later. That they're constantly looking for investors. So whenever they're around, you have conversations. Then in Africa, we have a program. We have a company called Founders Factory. They actually received quite a lot of investment right now, so they're putting in so much money in early stage, and they're focusing on, they prefer funding based on whether they trust the innovator. So they want to believe in you first before they even believe in your idea. So you can do an investor search the different investors that exist. You can search online, you can search on LinkedIn, you can have conversations with, in fact, this book that I'm actually taking notes on is by ASEC. So ASEC is the Association of Countrywide Innovation Hubs. Go to their portal. You'll be able to find a lot of these investors there. So there's so many in the country that, even with the Association of Countrywide Innovation Hubs, they'll give you Association of Startups and SME Enablers. That's what ASEC means. They have a huge list. But in Kenya, even online, just a Google search, you can be able to tell the kind of investors, and then you check the vertical that they invest in. Do they invest in the kind of businesses that you're in? Because sometimes you also don't want to waste time. Then, of course, pitch and due diligence. Please prepare for this, and then you can do your own mock. You can do your own mock pitch and due diligence, but ideally, it's part of the process. So once you've pitched and you've gone through due diligence, then you start negotiating. So you can do a term sheet, you can negotiate on what kind of investment terms are we talking about. Then you get into the financial and the regulatory part, which is deal structuring. You can structure the deal for this duration of time. At that point in time, you have shareholders agreement, you have a deal room set up. Now this starts getting technical, and most of the time, at this point in time, they expect you to hire the technical people. Probably most of the time, they'll give you the funds to do it. So it's not something that you're expected to figure out, that I need to understand finance fully at that point. To some extent, yes, there's a bit of finance you need, but at this point in time, you have the money to do that. With the legal, they will even start telling you, you're wrongly set up, would like you to change where your company is set up. Can you set up in Estonia? Can you set up in Delaware? These are zones that would be ideal for that. And then you talk about post-investment management. At this point in time, how often are you doing conversations? What growth strategies do you have? What is the investment looking to do? Then you talk about monitoring and reports. Now they expect to see to track reports. So every so often, they've now gotten either in your board or every month or every quarter, depending on the kind of arrangement that was in your deal structure, then they expect those returns. Now, those reports will determine whether they will continue to fund the company or they want to exit early. Then, of course, you talk about the exit strategy execution. This now that you have additional people in your team, it can never be discussed alone. With continued growth means a lot of startups get additional funding from the same people who invested in them. So if I continue to believe in it and I can see the growth is happening, then I want to remain there longer. It's the same thing we think about when you're running a conference and you find next year the same sponsor wants to remain. Why? Oh, they can see the value and they want to be part and parcel of this. Then you talk about iterative process. So most of the time what happens is with startups is you could be building a concept that needed to be changed. I gave a good example with Nala Money. They started with something else, and here right now they're doing money remittance from UK, US to Kenya, and they're doing so well. They've gotten so much funding in the last couple of years. They went into Y Combinator. Y Combinator gave them some funds, and as a result, they were required to iterate. So adaptability is, over time you start adjusting. You have to start conversations about your adjustment approach. So what are you adjusting to? You may need to adjust to different environments, different teams, to a different board member, to a different chairman, all those things. And with sustainability is, how do you make sure that your company remains sustainable, profitable and sustainable? Sometimes one, sometimes both. Now, as I mentioned, one of the biggest things that startup founders are afraid of is losing their control. But dilution is definitely going to guarantee that you lose some level of control. So how does dilution work? So when you think about an orange, yeah? So when you're peeling that orange peel, you have, I don't know how many sections of the orange. Let's talk about them being like 10. So when you start, you own the entire orange. Then you find a co-partner or a co-founder in the team who takes 1 or 2 pallets from that orange. So then you start getting an angel investor who gets another pallet. Then you hire employees. We give employees something called employee stock option plans, meaning your early employees, you want to retain them. You can't afford them. If I was coming in as your initial employee and I was supposed to do something, let's say finance, and ideally I would be paid 100,000 shillings, and you can only afford to pay me 20,000 shillings, then the option is I'll give you 20,000 shillings, and I'll also give you 5% stake in the company. So that's what we call employee stock options. So normally you always put this aside. So that further dilutes your company. Then you could be having these convertible notes and convertible debt, meaning you've gotten some shares, and you've gotten some money, and that the person may or may not opt to convert the debt into shares. So if they do, meaning they're getting some shares, again, further takes away from that pallet. Then we talk about stock splits. So you start splitting your stocks to the number of VCs that you have. You have under round 1, you have VC 1. Then you have VC2. Then maybe Kabaraki itself has even decided, I want to invest in this. You've come back as partner C. So the further you go, sometimes you might be left with that one single pallet. That's what we talk about dilution of shares. But it's still an orange. It's just that orange is no longer fully owned by you. It's now owned by so many entities. And that's okay. Because that orange, when you started, was maybe worth 10,000 Kenya shillings, which is how much you spent registering that company and a BRS. Now, that full orange is worth $100 million. Isn't it a better orange? Yeah, I hope it is. When that happens, your investors will expect you to prepare something we call a cap table, capitalization table. So these will tell you, 1, who are the different shareholders, the information, including their names, where they come from, and then you talk about the share class information. So we have ordinary shares, preferential shares. Ordinary shares is what you give everybody when they start. Preferential shares are given to investors when they come in because they're saying, I prefer to be paid first based on this kind of options. That's the whole concept of preferential shares. Never given to early stage founders, it's always given to later investors. Then ownership percentages. How much do you own? How much does everybody own? Investment history, meaning person A came and invested this, exited, sold their shares to this person. So we need to see that whole history under your cap table. Then you talk about dilution information. So how has your company been diluted? So it's been diluted this way. This is how the pie looks like, or the orange looks like. And your option pool. So an option pool is money that I can give to either employees or money I can give to future people. So as a rule of thumb with startups, you always leave a 10% of your shares unallocated minimum that you can consider as an option pool. You can give to employees or even some early stage investors. Later, we can, if it still remains, that's further deliberations. Now that you figure out how you're diluting, you have a cap table, how does your data room look like? If an investor tells you, I'm happy to invest, they expect to see this. One is a pitch deck. And I said, one pitch deck is never enough. You need to have 2 different versions. A kind of summarized version, like an abbreviated version, and then a much more detailed version when now they're interested to learn more. Then they want to see your financial statements. They want to see your financial projections. All this will fall under that. Then they want to see your business plan, or in the case of startups, we talk about business model canvas. A business model canvas was a concept created not more than 10 years ago, actually probably less than that. And it's a 1-pager that is supposed to give you anything and everything that I need to understand about a startup, as opposed to 40 pages of a business plan. It's a live document, You can change it as often as possible. So most of the time, the investor wants to see that. Then you talk about a cap table. I've mentioned it. They want to see your cap table as per this illustration. And then finally, the legal documents. The legal documents means, is the company incorporated? I want to see the incorporation certificate. I want to see the CR12. If you've ever gone to open a bank account and you're a company, you'll see they'll ask you a CR1, company incorporation certificate. They want a CR12 which tells you every single shareholder and director in that company. You may have employee agreements. They want to see that. You have agreements with third parties. You have data privacy licenses and permits. So those are the legal stuff that we're talking about that are needed. And they form part and parcel of your due diligence, which is a comprehensive investigation by potential investors to assess your investors' viability. So they want to see, are there risks? And if there risks are there, then they want to either leave or they can actually make informed decisions. So having a risk does not necessarily mean that an investor will walk away. They actually might stick around, but also help you navigate that. So the scope focuses mainly on finance, legal, and marketing analysis. So marketing analysis, they want to see, so whenever you're talking in your pitch deck, you'll have a market share structure. And you say, the total attainable market, in this market, I can sell these goods to 20 million people. So they want to believe that you can be able to actually capture the correct market, and if they've seen that market, is it a market they believe in and they can get into? Then, of course, under due diligence, they want to check timeliness and collaboration. So one of the things they will ask is, they will ask questions to decide, is this something that we want to be in? Is this something that we can bring in other people in? Is this something that we can get partners in? So this, while it's not a definite, it's not a document you prepare, it's part and parcel of the conversations you have. They'll, of course, look at how can they mitigate risk and how can they customize certain situations. Due diligence is always continuous. It doesn't stop at the point that you get acquired, it continues on. So it's all about a long-term partnership. And under due diligence is for you to prepare for that. And in fact, one of the easiest way I got into startup ecosystem is when I was doing professional support for due diligence. So you get, it's mainly lawyers and finance experts who focus a lot on due diligence. So you find a lot of companies doing this a lot. I'm almost winding down, so for those of you who are feeling like it's a lot, if you feel like it's a lot, unainua mkono unasema pungua kidogo. So the startup ecosystem is all about relationships. There are people who believe that, and I don't know, maybe they've seen so many movies that techies, geeks in a room somewhere, they're doing so well, and that would be good for you. By the way, if you're not building relationships, you may be having an amazing idea. It's a gold idea, but it's going nowhere because I can't see it. I guarantee you, there were better ideas than the ideas of Airbnb, Uber, Microsoft, even Tesla. I think a good story has been told about Tesla. It never started with Elon Musk. He just became the person who came and shouted it, and of course made some changes and did something about it. Similarly, Microsoft was never started by the concept of Gates. He acquired something from somewhere and built on it and pushed it. So this arrangement, these relationships determine whether your concept sits there as a sitting gold or it gets out. So relationships matter. You have to communicate. You have to go to networking opportunities. You have to come to some of these spaces. You need to shout as much as you can. Talk, blow your own horn. No one else will. Then you have to find people with mutual understanding. Not everybody is on the same wavelength. Not everybody has the same aligned interest as yours. So move on if it's not working. It doesn't mean that you beg. It's not a begging, it's networking. Value mentoring and track recording. So we emphasize a lot on mentorship. And mentorship doesn't necessarily mean that I do not know. It means it's almost like a fourth eye. It helps when someone comes in who's not aware of what I'm building and tells me, ooh, we could have done this and this and this better. Maybe you can, have you thought about this? Have you thought about that? Then track recording means like capture things that are happening. Take notes of data. By the way, data is a gold right now. Then of course you want to make sure that it's an ongoing engagement. Investment it should always be a win-win situation. So where you lose, and I've seen so many startups lose and come out crying, then you clearly did not understand, or you undersold yourself. So we talk about emerging trends. I like mentioning emerging trends because these are things that come that if you're not taking note of, then you're losing. Right now, and there's a humor that we've been sharing, and you've been seeing a lot of video clips talking about AI. So investors will come in and will listen to your idea, and they will walk away. You mentioned, oh, it's AI enabled. It's doing this with AI. Then they take a listen. They take a second thought, and they check on it. So there's a huge emerging trends right now in the ecosystem on AI. It's not to mean that everything has to be AI, but what it means is do not be stuck with doing things that you ideally traditionally do. Check what's happening out there and change. I gave an example yesterday on ChatGPT. So someone can decide, ooh, I'm not going to check what's that. You've lost it. There are virtuous systems out there. There are systems that make things so easy that ordinary, if you choose to ignore it, it walks away. The biggest danger with AI is, and this is something we've been talking a lot, is while the world is discussing about AI and getting into it and trying to get into that journey, in Africa, we are consumers, not developers. So we need to change that mindset. We need to get into that bandwagon and start building solutions that are AI-enabled. I mean, there was a time laptop was an emerging trend. Imagine. There was a time internet was. There was a time M-Pesa was. So if you got left behind, that was an issue. There was a time Safaricom, as I mentioned, was 2 shillings, 2.5 shillings a share. It was something emerging at that time. The other emerging trend we talk about is the fourth industrial revolution, or the 4IR. That's where you're talking about automation. You're talking about connectivity. You're talking about, of course, the AI also falls under here, but I tend to put AI on a whole different angle. And then, of course, you talk about technology convergence, where you start bringing two different things together. Yeah. So I was doing something blockchain, and then I've got AI. How do I combine that? Then there's a lot of conversation around sustainability. We cannot talk enough about sustainability. And that also goes hand in hand with impact investment. So the challenges we face are mainly two. Finance, I always say, is never a challenge. How you get it is you. There's enough money out there. It's how do I get it? So the biggest challenge is regulatory handles. So sometimes we get to a space where the regulations are not ready for us. Case in point, I mentioned we have blockchain as an issue. We either get it or we don't. So, of course, with regulations, they're there to protect the consumers. We talked about crowdfunding. I think as Kenya, we got left behind by South Africa and Nigeria because they got their regulations right, and they have sandboxes set up that got the regulations early enough. And because of that, their startups have been getting a lot of crowdfunding when we're still left behind. Then market saturation. Sometimes you have to be very careful about the market you're getting into. So you can get into a market, if you never did a market survey and you find that you're no longer there, you're no longer the only one. So the prospective opportunities that you need to look at is one is educational collaborations. Now that you're in institutions, how do I collaborate with the school? And how does the school collaborate with the innovators? And by the way, and this has been a challenge we've been having a conversation about, is people at undergrad level don't take advantage of this. When you go to my alma mater, where I know there's a lot of research, the University of Nairobi, a lot of fund goes into research, and majority of these are lecturers and research fellows getting into these PhD students. To some extent, a small number in masters, but the students forget about it. The students don't take advantage of it. So take advantage of this. It's so important. It's not just there for the research, for the R&D being done by the PhD students and the lecturers. It's also there for you. So take advantage of it. Then optimize your IP. Make sure you utilize, understand, is there an IP in it? Sometimes it's not there. Don't force issues. If it's not, it's not. But if it is, find it out, utilize it, commercialize it. Find ways of making money out of it. Then talk about Pan-African collaborations. So do not think Nakuru and it ends there. Don't think Nairobi, Kenya, and it ends there. Think, okay, what I'm selling, how can I get it to Nigeria? How can I get it to South Africa? How can I get it to Uganda next door? Digital transformation, we're changing every single day. So be part of that change. Don't get left behind. And of course, when you're talking about promoting innovation, again, I cannot stress enough industry and academia. I've seen, I think recently, I need to remember the name of the company, but there's a research product that was bought out by a company from the University of Nairobi, and they invested 100 million Kenya shillings to set up a research institute. So that was a partnership from industry and academia. Once I remember, I'll probably tell you that. Then, of course, we're talking about these Pan-African networks. There's an Africa Free Trade Agreement movement going on, where right now, I think we recently held Ghana-Kenya talks, and we had a huge delegation from Ghana that was coming in and trying to see how do we open doors. And to this point, there's an agreement right now. Kenya can take goods to Ghana without thinking about tariffs. Startups in Kenya can go set up in Ghana without worrying a lot about taxation. When we're talking about right now hiring people, we can now hire East Africans and a few other people, including from there, because of this, at no additional withholding tax when it comes to consultants. So we address regulatory issues by one. We need to be able to be pushing for sandboxes. And even in here, we have to think about policies. I know you guys may have an innovation policy, but how well do you know it? You need to understand it. And if you're understanding, then you need to be part of those stakeholders and be part of the stakeholder engagement. Challenge it where it needs to be. Leverage on tech. And leverage on digital transformation wave and check on emerging trends. Now, this is a time that I want to think through the success stories. In Kenya, we have quite a couple of venture firms. I'll talk about, and private equity firms. At this point in time, we talk about venture firms, angel investors, and we have private equity firms. So I just want to mention a few private equity firms that have done major works. Well, and it's not to mean because they're investing in these big companies, they're not investing in other companies. But what this means is when you see someone investing in, let's say, a bank thing, that means, and you're building something fintech, then they're more inclined to invest in you. So one of them is Actis. They started investing more than 10 years ago with CBA before they merged with NIC. They invested in EUP Old Mutual. Then you have Africa Invest, which invested in Cellulant, which is a fintech company that does digital payment solutions. And of course, they've invested in other things. We have Helios that focuses on telcos and energy. But the one that I want to focus on mainly is two. We have a company called Catalyst and a company called Fanisi. They both, actually, Fanisi invest in education. But with Catalyst, it focused and invested a lot in a company called Good Life. And the journey of Good Life is so interesting. Who's seen Good Life pharmacies? You've all seen it, yeah? So Good Life started in Kenya around 2014, and right now they have over 70 retailers. Now, they got the initial capital by Catalyst, which ignited the conversation. Then they subsequently got investment by a company called Leapfrog in 2017, and recently they got 30% acquisition from a company in Sweden called CFAO Healthcare. So this company has so far received funding of more than $100 million. Then you talk about Cellulant, which I last talking about, started by two Africans, one Kenyan and one Nigerian. Ken Joroge has been talking a lot. Started in 2004, did bootstrapping for 4 years, went into Series A funding in 2019, got funded by Ad Level Capital, then got into Series B in 2017, got into Series C, and right now, as of 2021, they've been planning since 21 to get into IPO. So cumulatively, I think as you can see in 2018, they got funded by a company called TPG for 47 million. And I think over time, they've continued to get more. They have now in their board people like Mo Ibrahim, people like Pierre, people like Bono. These guys are big in the industry. And what that does is it changes your landscape. So we talk a lot about fails, and for me, this is a company I like spotlighting. Now, funny enough, the two founders of Cellulant are no longer at Cellulant. That is what it means to be an exit. They talk about, we are co-founders of Cellulant, but they're still no longer at Cellulant. So now that you've seen this, what's next? I don't know what's next for you as an innovator. I don't know how you feel about this journey. Do you want to be part and parcel of this journey? Do you want to be the next Cellulant? Do you want to be the next Good Life? And I may not have, in fact, I want to mention two other companies, and probably they're not on my slides here. But there are two companies that have investment from the same entity. I was very shocked when I discovered about this. Who knows about Java? Java Coffee, Java Foods? Java, anyone? I see a few hands. Art Cafe. They actually have investment from the same team, same investment company, and they've been getting, and this has been building, and that's what made the two entities move. So that's why I say that sometimes you can get the same, even though you feel like you're competitors, even though you feel like this one is my competitor, go approach the same investor and tell this investor, since you invested in company A, and they're building this, why don't you also consider me and invest in me? So that's how you align. Same with Fanisi. They invested in schools that are similar. Of course, you have Hillcrest that subsequently was bought out by James, and I think they've invested in other schools. So when I mean that what's next for you, you need to think through, me as an innovator, what am I doing and how do I change myself? We talk about policy advocacy. You need to be a champion of what you're trying to see. Is there regulations? Is there policies in the institutions that you are in? What can you do different? Then you talk about education collaborations. How do you develop initiatives to bridge the academia and the startup gap? Then there's technology innovation. How do you harness this new tech? How do you harness community platforms? How do you use Zoom right? How do you use all these? Some may not be as complex, others are simple. How do you use emails? Recently, I was very shocked, and we have a cohort, and guys tell you, oh, we don't check emails a lot. Imagine an investor will not send you an investment term sheet on WhatsApp. Utilize tech, no matter how simple or complex. How do you make sure that you have a Pan-African network? We insist a lot and push a lot on building of African solutions for this market, but it's not to mean that you cannot leverage from external markets. A lot of these investments come from outside there, but also try and find ways of growing here. And finally, get into mentorship programs. Get a mentor, whether here or out there. Be part of this change. So I think that's a wrap for me. Any question?
Thank you, Wangeshi, and thank you, James, for sharing insights this afternoon. It's clearly, I think this is what you guys do on a daily basis. Clearly, this is your cup of tea. Yeah? And because you walked us the journey, right, from the word go to where we are now. And this is amazing. Are we still here? Sawa. So we will engage them in a short question and answer session. Just ask any question. We'll be doing 2 rounds as usual. So 2 rounds of questions. I'll be taking 3 questions in each, and your question is to be very brief. Just pap. Ukianza kupeana background ndio ulize swali ndakusimamisha. So just ask the question. Then I'll request the Wangeshi and James to also just answer the question. I don't know if you still require the laptop. Okay. So, thank you so much. So we're almost done. We're almost done. Let me see questions. There's a question there. Quick ones. Everyone party a mic. Question 2. Question 2. Question 2. Thank you. Yeah. Okay, please proceed.
Hello. I hope everyone is having a great afternoon. And my question goes to Wangeshi. I have about 2 or 3 questions. And first of all, you've talked about management and management changes and also investors changing focus in startup and also innovation. And the question is, how do we balance between what private investors want and also while preserving the core values and also the vision and the mission of the company while we have these management changes? And my second question goes to, because of the pressure that is given to innovators, do you preferably want innovators or ask innovators to go towards debts while getting their finance because of the issues that are in maybe private equity? And also, my third question goes to what is the criteria that are taken when picking an innovation or a startup in the private equity? Thank you.
So all the 3 questions went to Wangeshi? Yeah. All right, thank you. I think then one last question, because those were already 3. Yes, All right. So that will be the last question in this round. Then we do one more lap and we finish.
Okay, thank you, moderator. My question, and thank you, presenters. My question is on the policy. What is curtailing, from a policy point of view, what seems to be curtailing investing in startups, particularly as relates to venture, or what we're calling it, private equity? Obviously, this is a learning so that we can appreciate what are the policy gaps when we are doing similar research. Thank you.
All right. So let me start with one of the questions about how do you manage interest, or how do you make sure that you're not being swayed in the wrong direction. I talked a lot about aligned interest. So if you're trying to get investors, and the kind of investor you have does not understand you or is not in the same direction as you, then it's actually okay to say no. I give an example of a company that I've seen saying no to a lot of money. By the time we had it, we were like, why? Why? We'll probably not do it. But it takes guts to say no to something that's not aligning with you, something that's not in your vision, in your mission. But the way you mitigate this is, so when an investor is doing due diligence, make sure you do the same. You need to know, what are the vision? What is the mission? Does it align with my vision, my mission, my interest? Are they looking for impact and you're probably focusing on profits? Or they're looking for profits, you're focusing on impact. Then clearly you have something wrong there. So I will say that half the time it's a huge temptation to say no, but I think if you have something good, you need to be able to be looking at so many investors. And if it's already good enough, then you get the investment from so many people. Then in terms of pressure, do you go the debt route? Debt is just one of the ways. Pressure will always be there, regardless. You can either choose to bootstrap. This is, in fact, if you're doing debt, you also have pressure because you may have pressure to pay back. But if you're doing bootstrapping, then that's your money. You don't have to worry about, do I send it back? If I lose it, I lose it, yeah? With debt, you have to come back and pay. Then, of course, you have the pressure of, I need to make that money make sense. I need to be able to make that money on time and all that. Then finally, if you have VC fund, there's a rule we talk about in the startup ecosystem. If I'm going to lose money, I may as well lose someone else's money. Then what criteria are you looking at? There are so many criteria that people look at. One of them is, do you have traction? Do you have an idea? Do you have a good solid team? Is your team diverse, meaning you're not all techies and there's no one who can do finance or business? So those are some of the things that you're looking at. Early stage, mainly we're looking at your team. You as founders are everything, and then we look at your idea, because you're ideating. Then in terms of policy, what's curtailing the investment in, policy around in the investment and in venture world? I'll say it's how rapid the environment is moving. So when M-Pesa started, there was no policy around it. And we say laws, you cannot make laws and policy in a vacuum. They have to be made based on something, but you also expect the same, with the same speed that we're working on with tech, you hope that policy catches up. So one of the easiest ways in which we've been able to do it, and with the one company I can commend for doing this is the Capital Markets Authority. They have a sandbox. So that sandbox, what they do is they tell innovators, work with us. If you have an idea that involves investment from people, come, let's have that conversation, and let's co-create those policies. And that's how the crowdfunding regulations 2022 came into effect. So subsequently, we've been able to see, I think NSE has a sandbox, but it's not well known. So when you have these sandboxes, Nigerian sandbox has done so well, and that's why Nigeria is moving so fast ahead of us. Then we have the startup bill that has obviously been dragging for so many years. So it does have an impact in terms of what kind of policies are we getting into it. So, but policy is, we have different types of policy. We have policy at national level, but we have institutional policies. So it shouldn't stop at just at national level, even at institutions. What kind of policies do we have to manage in IP, for instance, to manage innovation, for instance? Even in companies, you have employment policies that don't make sense for the current ecosystem. If you move to companies like, I think, Google, as a startup, you're given 20% of your time to go build, and whatever it is that you build, Google will buy. But for a company in our normal context, is they will own everything you build. So there's no incentive. So policy cuts across, but it's how rapid we're moving and how open the ecosystem. And unfortunately, it's very political. Yeah.
Thank you. Let's appreciate Ongeshi. Asante sana. Is there another question? Any other question? You feel you have something you want to ask to Ongeshi or James? No, not you. Yeah, you asked 3 questions, so we can't give you a 4th one, unless it's burning. I would consider you because there's no other hand. So 1 question, I hope? Good, thank you. Thank you so much. I'm not blocking off your questions. It's a good thing for you to engage, because it means you're listening. So that's 1 more question, then we can wind up.
After an innovation or a startup has lost an investor, what are the common healing strategies for a startup that was funded with a lot of funds and finally just fell off to the ground? What are the healing strategies that are taken to measure that?
Thank you. That's a question to Ongeshi? All right.
That's actually a very perfect question, especially in the case of what you're talking about, so many startups failing and what happens next. So when we talk about exit strategies, we think about exit as only being bought out or only getting into IPO. There's an exit called death. A startup can die. And it's important to be able to understand if a startup dies, there needs to be a process. So a startup most of the time has assets. If the company is not doing so well, and you can clearly see it's not doing so well, most of the time the board of management will say, you know what, this startup is not doing well, let's file for either bankruptcy or let's call it as it is. If we only have investors. So what you do is you start paying out you start splitting the shares, the money, and the investment and the assets. You start paying out, of course, with the preferential investors first. That's why the shares are called preferential. You pay the investors first, the preferential investors. Then, of course, creditors. You have creditors, debtors, or so anyone who owed you money. If you had loans from the banks, they're creditors, you get them. You get preferential investors, then you get your normal investors. You, as a founder, are always last to be paid out. So when there's still something left, then you can get something out of it, yeah? So that's the unfortunate situation of a death exit, but preferential investors and creditors most of the time will get most of the money. If there's anything left, you at the bottom will get it. But it's part of the process, and what happens if you're in the startup ecosystem, they expect that that's normal, and you move on. It doesn't mean that you cannot be another founder. You can still go and build, because now, if anything, if you failed, we believe that you'll be more cautious next time. Yeah.
Thank you so much. We finally come to the end of this session. And I believe we have learned quite a lot. Private equity investment for financing innovations. A session Madam Wangeshi and Mr. James have ably taken us through. Thank you for sharing those insights. We look forward to engaging further when opportunity presents. We've been attending the 4th day of the 2nd edition of Central Rift Innovation Week. So this is the 2nd edition. The inaugural one was last year, and this is going to be an annual event. We want to thank our partners who have made time to come and be with us. Like, for example, now Answer Village, we have Kipra, we have ICTA, we have KCB, we have Equity Bank, we have Boresha. They have been with us, plus a range of so many other partners whose stands you can see out there, and whose logos you can see even on our materials. We appreciate you for sponsoring. We appreciate you for partnering, because we have to work jointly to push this innovation agenda in our country so that we can grow the economy and create jobs. We have the last day tomorrow, and I bet tomorrow will be the most interesting day. The theme is soft skills and entrepreneurship. We said earlier, there's a human feel to every innovation. You must know how to engage with people, you know? You must know how to embrace soft skills, emotional intelligence. You must have what we call people skills. And we have invited people who have thrived in that space to come and train us tomorrow. We will also have a keynote speech from a seasoned innovator who is quite skilled. He will be speaking about innovation and entrepreneurship that I bet you will be able to enjoy and you'll learn a lot. So and of course there will be lots of entertainment tomorrow. There's going to be lots of awards. So tunataka tukuje hapa saa 2 asubuhi, tuanze mapema. Tomorrow the session, I think we end at 1, so we're not going beyond 1. So tunaanza mapema, we do everything within that period and finish up on time. We've talked about people getting tickets to the Kenya Innovation Week. We've talked about awards including laptops, you know, so there's going to be a big morning tomorrow. You have no reason not to spend that time